Stocks have completely erased the drop from Tuesday after the CPI report heading into an options expiration close. So we'll take a look at how we've actually done the last few options expiration cycles. Actually a pretty significant move, in particular over the last 4 cycles. I'm going to show you kind of what the returns look like stacked up to other periods that are similar and some other period, and to kind of show just how there hasn't been one like this. So we'll take a look at some past precedent for this type of move on an options expiration cycle basis. We'll also take a look at kind of what's driving this price action, what some of the bigger movers are, and how the three-headed monster has been affecting or not affecting risk appetite here, especially over this past week. And we'll take a look at what are the bigger drivers in the small cap space, and one of the most important factors and the kind of parabolic returns we're getting in those. So our trade idea, of course, is a stock that has kind of broken down to the downside, unfortunately, unlike the rest of the market. And we'll talk about how to trade that in light of the broader market posture. So let's go ahead and get started. Today is Thursday, February the 15th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we created. All right, if you're watching us here on our blog, check out some of these other things on the right, including our Market Outlook live video, where I take a look at, first of all, I put on the trade before the market closes, and I also take a look at the old trades that we've done to see whether we should stay in them or not. I come down to the bottom, click this heart, it opens up this tab. I hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. That's why we always ask. It's really a big deal for us. So thank you to those who like this day in and day out. Those who don't, you can do it right now while we're watching. See if we can't get to our goal of 100 likes on these tweets. All right, let's start off taking a look at the S&P 500 here with the market forecast indicator. So you can see we're heading into expiration with a pretty decent return. In fact, if you look at really the last so many options expiration cycles here for the S&P 500, we've had quite a few in a row. 4 in a row now where we've rallied. What was the smallest one there? Almost 3%, 2.75% or more. So 4% there, 4% there, and 7% coming off that 5% decline. So 4 straight. That kind of harkens back to some of these time frames, but again, to get 4 in a row as the size that we've had. You can see like this one was 2.2%, and that was a pretty good run in 2010. You can see some of these others over here. You had, a small 1.76% return in 2020, coming off of the COVID low point. So it's not very common here. In fact, if I were to edit this and stick it at 2.79, which is where that level is, you can see in the last at least 20 years, we haven't had 4 in a row of that magnitude. We've had 3, but we haven't had 4 in a row of this magnitude or more. Only, and over here you had one in between coming straight off that COVID level. You had a 25% rally and then a flat move before you started 3 in a row to the upside. So, and again, if I were to change this to 4. It would not be the biggest 4 move higher, even though we haven't had a 4 in a row in the previous 20 years, because of how big that move was. That was the highest move. But really, outside of that, so here we are, 2024. So the move off of COVID, so March, April, May, and June, coming off of COVID there, and then this one here in 2019 coming off that 2018 low, and then again coming off the bear market low. I mean, that's it. It's a 4-month period that we just haven't seen a lot of as we head into the last move here. Sorry, go back to the one. So It is a strong rally, and we're closing at the highs of that rally again. And you can see that too when you look at the market forecast chart here, and you look at the 20-year chart with the options expiration cycle as the period. Again, you can kind of see the returns closing pretty much right at the highs of the period. What you were 7 points off of it there, you were 19 points off of it there. You were 3 points off of it here, and as of right now, we are about 19 points off of it there as we currently stand. And the intermediate line has crossed back above its market sentiment line after having crossed below it during the correction of 2022. It's now crossed back up above it here, with the near-term line is strong for the first time, right, as the near-term line has made its way. So we saw the drop below it on the COVID correction and drop back above it, move back up above it there. We saw a drop below it, mark the intermediate line on the 2018 correction, bounce back up above it there, and you can see the continued move higher with clusters after, right? So you got clusters after that, and that appears to be where we're headed towards here. 2015 and 16, we dropped below the market sentiment line, got back above it with some clusters after having gotten back up above it. We also got some clusters before we fell, and that wasn't necessarily the case. We kind of got one there going into the Thanksgiving, right before Thanksgiving expiration. And then 2011, you can see we were nowhere near the market sentiment line at the time because we had just barely gotten back above it in 2010, coming off the bear market low point, having crossed below it over there. So we are 17.5% up above the 30 month moving average on an expiration cycle basis. You can again see how significant of a move that is there. But it kind of goes to show just how strong this chart is for 4 cycles in a row. 1, 2, 3, 4. All of those 4 closing right at the highs. And we'll do that again here, up 3% above. Market sentiment is slightly above its, intermediate line is slightly above market sentiment as it stands. So we'll see we filled in the gap. That drop on CPI is what brought it down here, brought the near-term line down to almost bearish territory. But we are back up to bullish territory. We are almost back into the reversal zone again, without second time now, without the momentum line even getting close to getting up to the reversal zone. So that momentum line would suggest that the near-term line probably won't stay up here for very long. Probably won't get very high and won't stay very long up in the upper reversal zone. Again, nothing's 100%, but that's what the lack of the momentum line would suggest. The near-term line, or the Dow Jones, the intermediate line did cross below market sentiment. Your short-term sentiment's bouncing is not as bullish as the S&P 500 is, or the NASDAQ, which is driving that. There's the NASDAQs. The Russell 2000 has been a little bit more bullish thanks to the super micro computer company. The stock is going haywire right now. And it's helped the intermediate line almost cross above market sentiment. Will most likely cross above it tomorrow, barring a significant breakdown. We had a pretty significant breakdown on the CPI after a pretty strong run up, and we'll see if that ends up being the case here. Your near-term line is close to getting in the reversal zone and has crossed back above the intermediate line. So that is a bullish sign there, and we'll see how much follow-through we get now that for the first time here we have the dark green shading in the green line. We briefly had it over here, but that was it. So we'll see if we can break through 2000, in this case 2070, and get up to new highs and continue to trend higher on the Russell. All right, taking a look at the weekly chart, you can again see such a strong weekly return. Only one down week on the Hagenyashi candle. Everything has been up again, higher high, higher close. The size of the candle continues to converge as the PPO continues to rise up to relatively strong levels again, higher than where we were going into Thanksgiving weakness when this kind of all started. The correction all started there. So good strong move again here, good strong trend. obviously above 5,000 and continuing higher. Your Russell 2000, which has looked a little different, has now turned back up and has after multiple transitions, has a bullish candle here. A little bit of a lower shadow, there, but at least it's back to a relatively decent size bullish candle. A little bit of a long upper shadow, kind of, again, we talked about the significance of having long upper shadows, so we'll see how much of that gets filled in tomorrow there. Looking at the 3 green arrow charts, again, not surprising to see mostly 3 green arrows, at least 2 green arrows. You have a red arrow on the MACD across all of these, so there are some of these are in convergence mode. IWM has 3 green arrows again with this breakout. In fact, if you look at the day we got the 3 green arrows, the last couple of days we've had at least average, slightly above average volume on those. You can see on the 2-line basis how the S&P continues to grind higher. Everything pointed up to the right. On IWM, it's more of a recent phenomenon, but you have the 8 and 17 day have crossed above the 30. The 30 had been moving towards converging onto the 50, but not crossing below it. MACD and stochastics are both rising there as we are above the value area and moving up and away from the support levels. Looking at the DMI, strong pattern, well above 30, back below 25 on the negative indicator there. IWM has also crossed above 30 on the positive and crossed below 25 on the negative. You still have a pretty low ADX because you need to get below 20 on the negative to really get a trend going. You see that reflected here. SPY still has a very mature trend going there, but IWM, that's not the case, or you don't even have a weak bullish trend going. Even though you have a positive rate of change, you're above the Ichimoku cloud. The green line's crossed back up above the blue line here. So it looks positive. We just don't have enough of a move yet to warrant a new trend. You're still positive on the RSI and the CCI on the S&P. The Russell 2000, you're back above 60 again. You're making another run at being above 60, back above 150. The weekly CCI is still turning back up. Your RSI on the Russell is above 60. It's almost at 75 on the S&P. So again, goes to show just how strong that move is, and still above 70 as well on the NDX. We look at the Bollinger Bands here. We are clearly up above the upper Keltner channel again. Even if your momentum is waning a little bit, you're back in the upper quartile of the bandwidth, has been for quite a while. The bandwidth itself is outside the Keltner channel, so you have the green dot still. You've had a pretty decent run of green dots with only a small period of convergence right there where the bands came inside the Keltners, but you never did get a bearish momentum move. In fact, this is one of your longer bullish momentum moves that you see without a bearish move in between. We had one right there in April and July, and we saw the kind of intermediate decline that came out of that. But other than that, yeah, you can kind of see, it's rare to get, this long of a move. You kind of got one there coming off of 2020. You got one over here as well, coming off of this low point, just a brief little pullback here. So it kind of goes to show, there's another one right there too with, an extended bullish intermediate move with some red dots in there, but the momentum stayed bullish that entire time. And then that led to, the decline, the COVID decline. So it's not the best thing to have such a long bullish run with, red dots that are kind of, with a convergence period without a consolidation period. It's always good to get, these small little moves. It's healthy to get these small little 5% declines, but here we are at a 22% rally. It's not the biggest number. I think I've shared with you before tweets that this is right around that 6th, 7th, 8th level in terms of the biggest returns that we've had without a 5% decline over the last so many years. So it's not the biggest number, but it is a relatively decent size number. Figuring that we're not, this we didn't have a high VIX level or high volatility level, or however you want to measure volatility, even if you don't want to use the VIX anymore because of the 0 day to expiration options. There's lots of other ways to measure volatility, and none of those ways showed washout levels like all these other periods where we had big, strong numbers in this green box. So 22% for a normal move off of a normal low point is a pretty big number. Again, without a 5% decline coming off of it. So, but that doesn't mean that it can't keep going up, and you kind of expect that it will keep going up to whatever number it ends up being, but it always will end up being a higher number than what anybody would expect. The problem is after that, again, you had this big number, you had this big number, and you had a long period of volatility coming after it, and same thing after this big number. And that's the problem with getting the big green numbers without the 5% declines is eventually you do consolidate, and it's tends to be more painful if you don't consolidate normally in between. Let's take a look at today's intraday move. We did get up near to a new high. We're back up to last week's high point. Obviously, this week's low is pretty close to last week's low, and as of right now, this week's high is pretty close to last week. It's actually a little bit higher because Monday's high was a little bit higher, but we're sitting right there. So very similar range to what we saw last week. It's bringing the 4-week range down as the lows will keep moving up. Now the low is going to move up to there, and then tomorrow it's going to move up over here and be there for a while. So we have the potential of getting another kind of one touch. I don't think it will get above 70 again, but it might get above 50 here when the low point moves up into that area, at least getting really close to 50 when it moves up there. So you're going to have a really small gap or range again for the 4-week channel as that moves up. So that's been kind of the MO. We go up, and then we just go sideways for a long time, and then we go up, and then now we're in the process of going sideways again. Again, a period of convergence, without necessarily an actual consolidation pattern. I showed you the range and this chart here. The volume ends up back to being below average. The range also back to being below average. So we continue to kind of falter despite the one day where we actually had a pretty decent move. We continue to really stay at low levels below or near the 85%. Being below 80% is the extreme there. The volume is continuing to move lower, and of course the volatility, interestingly enough, has not really moved lower. Now, Fridays tends to be a pretty negative day for the VIX, and we'll see if that ends up being the case. You assume it will, and the VVIX too. So assuming that we drop back down tomorrow like we did last Friday, back towards, at least towards like below 90%, if not closer to 85%, with the VVIX closing below 80, assuming a bullish day going into options expiration, then that will set us up for coming out of options expiration, and again, going into a period of seasonal weakness for the S&P 500. As you can see right here, this is a seasonal peak for the S&P. It's also a seasonal peak for the Russell 2000, and it's a seasonal low point for the VIX. It tends to make a run up from here up to its highs of the year, generally right around mid-March, right around the March expiration date. And we'll see if that ends up being the case after we get another day before expiration tomorrow. All right, now let's talk about what's driving this price action. Again, you can see the strong run that really all U.S. equities have had, especially against international stocks over the past 3 months. But again, let's go back to the date of the jobs report. That's when things really changed. From a yield perspective, you can see yields jumped up and continue to stay higher off of their peaks. So bonds are off their lows, but that's really when the narrative kind of changed to a big, strong move higher in yields. The dollar has rallied and stayed strong. Commodities have rallied too, but then have come off of their peaks of the last couple of days. Despite that move, IWM and the Qs are really strong. So if you take a look at some of these moves higher, especially like the dollar, you can see it's on a near-term pullback as we speak. The near-term line the last couple of days has really come down. But again, there's the jobs report, and you can see we're still well off those We're still up significantly with the near-term line dropping as much as it is to a near-term, what would be a slightly higher near-term low, and a strong bullish intermediate posture that persists. Market sentiment still in bearish territory, so it's still in this nascent bullish stage here. If you take a look at the 10-year yield, it's the same thing. It just had a cluster a couple of days ago, finishing with that cluster up there as the intermediate line just approaches getting inside of the reversal zone. And now your near-term line is pulling back a little bit over the last couple of days, but still up above this 4.2% level, up at 4.24%. So still very strong from that regard. And then finally, crude oil, which is a major component of DBC, it continues on its bullish trend, and its market sentiment line also still in bearish levels, and the intermediate line crossing back up above. The near-term line is below the intermediate line, so there's a little bit of a decline over the last couple of days, and we'll see how much longer that stays before it gets back up into. This is the impact it's having on the commodity index. Your commodity index getting a bull tag here, a light pink shading and a yellow line. Again, is that a sign that we are moving into a bearish trend? We never really had a bullish trend we only had like a couple of days of dark green shading a green line, or is it the bounce at beginning stage of a move higher? So obviously your near-term line crossed below the intermediate line and down into oversold levels. Your market sentiment is still down there in oversold levels. So we'll see if we are able to come off of these oversold short-term sentiment and bounce back up or not. Again, that's the three-headed monster, right? So we've had a couple of really good days to the downside for all three of those major asset classes that impact risk appetite negatively, and as a result, stocks have rallied, and you've seen a really good sign of breadth as well when you look at it. The breadth here, like the McClellan oscillator, getting back above the positive 35, so that's a good sign for the breadth. And you can also see that too the money flow. So this is the volume that gets shown by the price, continuing higher as well, well up above these old highs. And of course the weekly index is still up above 90, so very extreme during this 16-week rally that we've been on. Other breadth indicators that we look at, the new highs and new lows index, for an example, also jumping up to a high level. You can see back up to almost positive 400, back above the moving average there. And you can see the number of stocks breaking above the 50-day and making a pretty significant run up, still below its moving average. But you notice that the number of stocks above the 200-day did get back above its moving average. Now, the last couple of times it did, it failed, and we'll see if this is going to be a little bit more longer lasting. Because if it is, then you expect this will continue to really move up sharply, and it will bring this ratio down. As of right now, it's slightly below its moving average, and if it can get back below that and get back below 1, then that's a good sign that we are trending back up again and moving higher. And so we're kind of close to those levels. The MACD would be rolling over in that case if it did, in fact, break below the moving average. So those would all be good signs of breadth. Of course, the skew continues to be really, really high, a second straight day above 160. Those are very, very high levels. In fact, the moving average for the skew is back above 150. It's not, that's very rare for it to be this high. In fact, the only other time the 20-day average of the skew is above 150 was in 2021. So there's a lot of fat tail risk, a ton of fat tail risk out there right now, and that's what the skew is measuring. It's not common for the skew to be this high, but it goes to show just how strong the move has been, and we're really starting to see, like I showed you some of the rate of changes, but really the big thing that's driving the Russell 2000 right now is its biggest component, and that is the super microcomputers. You can see over the last 1, 2, 3, 4, 5, 6 weeks, it's really gone parabolic there. Let's take a look at the rate of change on a weekly chart for that stock. Again, which is now the biggest component in the small cap index. There's your 6-week return, up 250%. We started the 6 weeks, which would be, again, basically the beginning of the year at 292, and now we're up to 1,000. I got up to 1,000 today. And we'll see how much of a round number that ends up being, if that ends up being a significant round number that acts as resistance, or we just pause right through that. Considering the rate of change and how parabolic this move has been, right, you would expect that has potential of being a significant resistance level. You can see the ADX is almost at 70, and that's just unheard of for it to be that high. There's been other instances where it's had good, strong runs, ultimately ending in clusters on both of these other instances, getting a cluster up here before that divergent high point that sparked the weakness into the end of last year. And there's been some other moves all pretty much culminated with clusters. Well, here we are. This is the lowest the negative indicator has been. It's the highest that the positive indicator has been, and your ADX is almost at 70, and we still haven't really even gotten a cluster because of how bullish it continues to be. We don't get the momentum line. We don't get the really significant ranges, and as a result, the momentum line is not getting up to extreme highs, even if we are 93% up above the 30-week moving average, which is obviously the biggest level of the past year, and would be the biggest level of the past of its 20-year history as well. Nowhere near did we ever get. The only other time would have been right over here, where we did get what would that be? 670% up above. And like I said, we are now currently at 93% up above the moving average. So this is the biggest reason why the Russell 2000 is doing as well as it has been. In fact, if you go back to that 6-week run, really to the beginning of this expiration cycle, but if I were to go back starting on January the 19th, let's go over here to the asset class comparison chart and go to January starting on the 19th going forward. You can see the Russell 2000 has had its bouts, right? Every time that stock has made a run, the Russell 2000 made a big run, and it's up 7% over that time frame, outperforming the Qs and the S&P and emerging market stocks because of that one stock in particular. So again, if that stock ever consolidates at all, it's going to have a very significant negative impact on the Russell, which interestingly enough has a couple of common gaps that we formed over the last couple of days here. These two common gaps. We filled in the gap from Tuesday just like the S&P did, but in the process we formed a couple of common gaps that we would be susceptible to filling in if that stock were to ever show any signs of consolidation at all. Let's take a look at the sector moves here. So bear with me 1 second while I bring up the comparison chart for that. And then we'll go back again to the jobs report Friday. And from that point forward, you can see XLK, XLY, XLC have been outperforming. Industrials has done a really good job. Energy has bounced back up, which typically does well during bearish markets. And of course, your interest rate sensitive safety trades are down here at the bottom. If I just look at today alone, here, you can see it was an energy and real estate materials all ended up to the upside. Remember the dollar being weak. These are dollar sensitive areas. Interest rates, not going up, being relatively weak. So these interest rate sensitive areas move up higher, and then of course financials too, with technology interestingly enough underperforming. So the S&P was only up 0.5%, yet every single sector outperformed the S&P except for one sector. It goes to show the influence that sector has, because some of these sectors 2.76%, 2.38. This is why the Russell did so well. 1.91, 1.69, 1.66 for utilities. These are some strong returns, and because XOK was down, the broader market, not so strong of a return. All right, now let's take a look at our trade idea of the day. Let's take a look at Deere. Deere, obviously in the news with its earnings, breaking down because of its earnings, and you can see the intermediate line had already crossed below its market sentiment. You already had dark pink shading and a red line already going into the earnings announcement. And then, of course, your near-term line had been up above 50. Not the case now as it's dropping back down. It has a bearish candles this week, forming a bearish candle coming off of the earnings. PPO is just turning back down. You got a pretty strong size bearish candle here. If you look at the 3 green arrow chart, you have broken below all these moving averages. The 8 and 17 are below the 30. The 30s cross below the 200. You're below the point of control. You're at the bottom of the value area. So you're setting ourselves up for a move down to the downside. The DMI, obviously, a lot of these charts are going to show breakout patterns, which isn't surprising. There's a breakout pattern there on the DMI, the RSI, and the CCI are also showing breakout patterns, very significant moves lower there. And then your Ichimoku cloud, you can see just starting a new weak bearish trend below the cloud, the green line below the red, a very significantly bearish rate of change. Your Bollinger Bands and your Keltner channels, you are below both the lower band and the lower Keltner channel. And the bands themselves are still inside the Keltner channel. You're just starting to break out of the Keltner channel, the bands themselves. So we're just starting this move. But considering how much we already have moved, makes me want to, instead of doing a directional trade, doing a bear call spread instead, selling the what was at the time a 40 delta, selling the 370, buying the 380 during the Market Outlook Live, and then there's the setup there, and then you can see what it ultimately does is it puts that break even is going to end up being right there above the gap or the move where we had our high today. So if you look at it from this perspective, as long as we stay down here, if we start to fill in that gap, then we're not as bearish anymore. Obviously, the bearish breakdown, all those breakout patterns are kind of nullified at that point. We don't want to be in it anymore. So at that point, we'll be down, almost a couple $100. So we'll have a little bit of room. We're willing to lose 320, but it kind of gives you an idea that we have to kind of move up into here before we lose what we're willing to lose. And at that point, we don't want to be in it. As long as we stay down here below where we gap down to, or even lower, then we make our money on this trade. That's kind of the point of the bear call. So little directional, but not too directional, considering how much of a move it already has made in response to that earnings announcement. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your weekend or Thursday night, everybody, and we'll see you all next time.